Hello and welcome to a wonderful Friday. We're doing Stablecoin week, and today I want to talk about Maple Finance. Let's just hop right into it. Now, as a very quick recap, we had USDAI, that is a lending platform around GPU scaling. Then I moved on to Origin Finance, which is sort of an automated smart contract mechanic that takes your money, moves it into Aave, Morpho, that moves it into these over-collateralized lending borrowing platforms that allow you to borrow against your crypto. Last but not least, the Tempo announcement came out yesterday, and we're seeing the payments chain wars start to pick up. We now have some serious competition there. But today, I want to talk about a slayer in the modern DeFi arena, which is Maple Finance. And the long and the short of it is that Maple's unique edge here is that they are an aggregator of liquidity. Anyone can provide their stablecoins to Maple Finance for under-collateralized lending to institutional partners. So unlike Aave and Morpho, it's not available to anyone to take out a loan via Maple Finance. You actually have to be an institution to be vetted and to have a reputation that you're putting on the line. That's the only way this under collateralization works. The reason the other protocols do over collateralize, say put in $1 and borrow 50 cents, is that in the case of a default, they take your full dollar. That is how those protocols accrue value that they then pay back to their token holders. In Maple's instance, they allow anyone to contribute stablecoins to a variety of pools that have varying risk profiles. So you can place your money wherever you like. Now, one thing to note about just basic crypto protocols versus the banks is that we do have these bribery mechanics built in. Bribery is generally considered a bad word, but in economics, it's really just an incentive to get a desired outcome. So the crypto protocols use this all the time, often through something that they can control, which is the inflationary leverage of their own governance token. The Maple governance token does permit participation in the governance decisions of the protocols. It also takes all of that lending APY and sort of allows you to earn some upside on it. So if you wanted to accrue value, you could simply hold the Maple token. But for the sake of stablecoins, we do have these bribery mechanics, which is time commitments. So you can see that you drip out sort of rewards on the platform. And the longer you commit your stablecoins, we can see 3 months, 6 months gets 1.5 to 3x the drip. And that is because this means that the protocol has more capital to lend out. More loans means greater APY, greater revenue, and the whole protocol rises together. So that's why they are bribing you to go longer on this. Now, the thing is, these different pools, they did suffer in the past. They were around with the Three Arrows collapse, with Celsius, BlockFi, Voyager, all of these lending partners that just took too much risk and got caught up in the collapse of the last cycle. That's what brought down everyone. So there has been this move towards this new product, which is Syrup USDC and Syrup USDT. I'm just going to call them S stables to make it easy. Now, the S stables enable direct access to Maple pools through an interface and a smart contract router. Maple established new unique pools for the S stables to ensure that the proceeds and risks are segmented from existing pools accessible to Maple customers, those borrowers. The legal structure has been created to reflect the segregation between Maple, Syrup USDC, and Syrup USDT. So traditionally, the capital that would go into the Maple coin would be part of these pools, whereas the stable coins are going to be a little more risk off. I believe they're going out, getting T-bills, getting short-term loans, and paying back a lower yielding return. This is very much catering to my point that the Genius bill does not permit stablecoin issuers to share those yields, but it says nothing about protocols, and that's where the banks get fucked. Now, what's interesting about the sUSDC and these S stables indeed is that the yield actually returns to the price of the coin itself, and we can see this as accruing since March 2025 in a steady march up towards present day. We have $1.08 starting here to $1.12, and that's because they take these yields and they actually bake it back into the price by rebasing the token. So unlike other stable coins where, you put in $1 and you get one back, you would get that ratio based on the rate at the current time. However, those S stables that you hold are going to increase in value, and it's a very different mechanic from a lot of what we see outside. Now, one of the kickers is you can take this S stable coins and move into something like Camino Finance, which is actually more of a Solana lending market, but everything's starting to cross-pollinate now. And Camino does allow you to take these more aggressive strategies like looping, which means you lend, you borrow, you lend, you borrow until that capital is really squeezed, stacking your APY, but also stacking your risk. Now, they do offer a couple different things, right? It really depends what are you lending. Here we have Syrup USDC, which we know is backed by USDC and USDT, so fairly risk off, and it's borrowing USDC. So we know that still pretty risk off, but look at this APY. I mean, holy moly, it's at 40%. So Syrup Syrup is a yield-bearing receipt token representing fixed-rate, fixed-term lending positions, lending assets to over-collateralized borrowers on Maple Finance. But we can also see there's a different profile around borrowing USDG, which is a coin that I am not as familiar with and I wouldn't be as comfortable. But what we can tell is that placing our stablecoins into blockchain protocols offers all sorts of opportunities, not just to take advantage of these unique features that are coming out with the different protocols and the different players involved, but to also loop, to compose into other financial ecosystems. We can stack our capital in smart ways because it's just like stacking data. And of course, as I say, the future is in these small teams that can scale. Maple doesn't have to do any of the ledgering, right? They don't have to keep track of each trade because that's all on blockchain. So they can focus on accruing the value through the front end from LPs, liquidity providers that lend those stablecoin assets, and focusing on the relationship with the institutional clients that take the borrow on the other side. And in this way, they're able to scale, and it's super cool. And of course, if you have Syrup, you can come in and you can get 40% APY for as long as that lasts. But this is fairly risk off, and that's a phenomenal number. And we're seeing where it comes from. Of course, this is a multiply product, right? So it says earn yield via automated loops. So you are taking on more risk. They have other formats that are not looping, that are just a little bit more succinct, and they have significantly less yield. It's all very interesting and fun. And I've been having a really good time walking everybody through the stablecoin ecosystem. Next week, I'll be back to my usual format. As always, any click on the like and the subscription would mean the world to me. So please get down there and do it, and know that I'm hugely appreciative. As always, the market's been pretty wonky. We don't know what we're going to wake up to tomorrow. So don't over leverage, stay safe, and I'll see you on Monday.